Hello, everybody. Very excited to present another real estate market update. And we have an outstanding guest today. Many of you have seen him before, either on our real estate market updates or on his very impressive social media presence, or maybe gone to one of their quarterly events or something of that sort. But Steve Davis is here again. And Steve, welcome.
Good to be here. Thanks for having me.
Absolutely. As you guys may or may not know, I'll cover a couple things and let Steve talk for a little bit. But Steve has been in the business for about 30 years. He is the owner and founder of the Total Wealth Academy. They are simply an amazing mentorship organization that not only helps people understand how to successfully invest in real estate, but just how to be successful and happy in all parts of their life. And they cover the widest gamut of real estate investment types that I'm aware of too. Some people focus on one particular area, but Steve and his team have a very diverse background and a very diverse group of contacts. So I think they're absolutely incredible. We work with tons of their members, and they help them be incredibly successful in that single family 1 to 4 space that we specialize in. But they're also very successful in other areas. We did a deal night last night with Steve and his team. Went incredibly well. Sold 100% of our inventory in the single family 1 to 4 space on site. So it was just a great event. Tons of people online attended as well. So if you're out of the state or out of the Houston area, you can attend those and we can give you information on that. But Steve, tell us a little bit about what's going on with Total Wealth. Have any exciting things on the horizon?
I think I better build on one thing that you said, that we are the most diverse uh, investor program in the United States, in that we do single family, small apartments, big self-storage, senior living, strip shopping centers, city centers, hotels, movie theaters. You know,
Movie theaters.
yeah, well, that was part of a strip shopping center. Um, but you name it, if it builds cash flow and it appreciates, we're investing in it. And the goal of the Total Wealth Academy member is to build a second stream of income that meets and exceeds their wants and needs. And we're doing that through all types of real estate investing. And as you mentioned, it's a mentoring program where our members enjoy unlimited question and answer with the mentors at Total Wealth Academy to walk them through the process. It's very effective.
I was going to ask two things. I know I don't think Wade mentioned you have a radio show and a podcast. So
Yeah.
where can people find you? Where can they find on that?
The easiest thing is to go to totalwealthacademy.com/radio. They can get this radio schedule. We're on in Dallas and Houston live, but we podcast the Houston radio show, and that's also at totalwealthacademy.com/radio.
The other thing I noticed lately, very excited because I'm, obviously I get all of your emails. I've seen an uptick in like deals being presented, especially on the single family side. It seems like your agents have started to hit your stride, and you're able to put some deals out to your members a lot more lately, for sure.
Yeah, but the deal night last night still dominates um, with the number of deals that are done. It's just amazing. That deal night has turned into one of the most popular events. We have so many people reserve, and they just can't make it for whatever reason, but they'll be here. They'll be there next month, I hope.
We had a
Um,
ton of people online.
yeah, it's yeah, our realtors are really busting their butt to find the members deals.
Yeah,
I noticed.
we have an amazing amount of deals right now with one of your people, Boris. He presented last night as well. But you have so many agents that really seem to care. It's pretty impressive.
I appreciate it.
Yeah, for sure. All right. Do we have anything else big picture on the horizon, Steve, that you want to talk about? Any events coming up?
No, we have our basically our Wealth Accelerator class, also known as our free sample class coming up. Anybody that's interested in that, if you want to learn what Total Wealth Academy is really doing and how you can participate, go to that Wealth Accelerator class. Just go to totalwealthacademy.com and it will say free sample class. Just click that button and you can reserve a seat to watch it live in one of our offices or online.
Excellent. Excellent. All right. Well, let's dive in. I do want to go to the disclaimer and then I'll cover the catalyst value proposition real quick. As you all know from previous presentations, or if you're new today, this information is for general purposes only. We're not giving any investment advice, certainly not any particular investments or categories. We just want to give our own personal opinions of the market, and you should do your own due diligence before you invest in any type of real estate or other investments. All right, let's go to the next page. I want to cover a couple quick things. Right now, we are definitely in a mini refi boom. Interest rates are at about a 3-year low. We are not as low as we were a few years back, but there are a lot of people who are taking advantage of the opportunity to refinance because we are about 1.5% below the high of the last few years. We also have a lot of people who are taking advantage of cash out refinances to fuel their real estate investment goals. For example, we have people who are taking cash out of their primary residence. Steve always talks about this. You don't want to have debt equity. Debt equity is doing nothing for you. If you have equity in your primary residence or in some of your investment properties, it's a great time to take that out and get into the market. We're going to cover a lot today that we are in a buyer's market. It's not the easiest time to flip. You can do it if you have a great plan, but it's not the easiest time. It is a great time to buy and hold properties without question. Buyers markets are the times to buy and holds, and we are in that market. And if you need cash to do it, or even if you have a lot of cash, but you want to do a hell of a lot more deals while the market is right, it is a great time to do that cash out. A couple other quick highlights. We offer excellent DSCR loans. We're actually talking with somebody at the deal night last night with Steve. The guy was kind of perplexed. He's like, hold on, I lost my job. Are you saying I can hold real estate whenever I just lost my job? Yes, that answer is an absolute yes. There are DSCR products where you don't even have to submit income docs. We're not going to ask for them. You don't have to submit them. You are able to get qualified to hold these properties based on the property's ability to pay the mortgage. That's it. So you don't have to have a job. You could be a full-time flipper, full-time investor, full-time wholesaler, just lost your job, retired. Any of those categories can do wealth building with long-term holds. So if you want to learn more about that, please reach out to us and our loan officers and we can talk about those products. Jeff, anything on that category before we move into the presentation?
No, like you said, I think a lot of folks are. I was looking at rates. Like I said, they're the lowest they've been in at least a calendar year. I'm looking at the Freddie Mac chart. It's the lowest they've been all year. Um, I think people are, like Steve said, and you said, waking up to the fact that you have debt equity out there. Values, while they're a little down, they're still very strong, especially if you bought the property, I don't know, maybe 2-3 years and beyond. So it's a great opportunity to pull cash out and pick up some properties now because, we've said it in the past, when rates drop, everybody wants to invest. And so they come running into the market, and the cash out of pocket to pick up these deals goes up. So your return on investment is significantly lower. Now is a great time to pick up properties because rates, while they're dropping, there's just not as much competition as there used to be. So it's a great chance to get into some deals now with very little money out of pocket.
Absolutely. All right, let's dive right in. All right, so the Houston market, I know this is your area, and Steve, you and I were talking last night, and you said you kind of deep dove some of the data. So,
Yeah.
what are you seeing in the Houston market?
Well, if you look at the months of inventory, 5.2, I've seen it as high, estimates as high as 5.7. That's more of a balanced market, but it's still leaning, it leans towards the seller. But I think you're right, Wade. We're in a buyer's market. and
Yeah.
that's why it's so hard to sell these flips, you
Yeah.
know. Uh, but no other major changes. But it is nice to see us getting into a more balanced market, having a few more houses available for both investment and owner occupants. Days on market still pretty high, 55 days. That's wild. That's got, you know what? That includes the big expensive houses too.
Sure.
So that's
Yeah.
why that average, because I was going to say these $300,000 and below houses, they're not taking 55 days to sell. They're taking 5 or 10 days to sell. So
Yeah. I
that's,
mean, just my anecdotal experience to back that up, Steve. I have a few properties that in my rental portfolio that I'm going to be shuffling through because some of them ended up in a flood market and the cash flow is not exactly where I need it to be, and I can reallocate that capital. But they're below 350,000 and they're all selling quickly. They're not sitting out there forever. So I was talking with somebody last night at your event who was talking about doing flips, and I gave him 3 pieces of advice. Make sure you buy them right. You can't overpay betting on the market to go up. That's something you could do back in COVID. You can't do that now. You have to put out a very good product and be able to list at a slight discount to the market. If you can do both of those things and you're not in a higher end bracket, you can flip
yeah,
in this market. You need to be below 500K, right? In my
agreed.
opinion, that sweet spot is like 300 to 500. If you're below 300, it's too good of a rental, and some other buy and hold investor is going to pay up for that. But in that 300 to 500K market, if the cash flows aren't great, that is a great flip price point where you can get a good purchase price, crush it on the product. It doesn't have to be amazing at 500K. It has to be amazing at a million. But at 500K, you can put a good, strong product out there, list a little bit below the market, and sell pretty quick.
Yeah.
All right. A couple other things that jump out here to me. If you look at the active listings from September of 2019 to now, it's about double, right? So that is a major factor. And the sales are relatively comparable. And that's why we're at 5.2 months of inventory. That's why we're at the comparable days on market. Like these months of inventory days on market numbers aren't drastically different, but they're definitely up. But here's the thing. If it's a little bit more difficult to sell a flip, it's also more difficult to just sell your home if it's in less than perfect condition, which is the target home for real estate investors, right? So that's why the wholesaler community out there is getting good deals for real estate investors. Last night we did a deal night. If you haven't attended it, you should definitely check it out. But we had I don't know, maybe almost all the properties. I'd say the average out of pocket on those deals was maybe 10K. Some of them were even lower than that. And that's just an amazing out of pocket number that you do not see when rates are low and you do not see in a seller's market. Back whenever rates were low, our average out of pocket on Catalyst hard money loans is 45K. So if you're waiting on the market to turn, the reality is in your mind, I don't want to invest in real estate until rates go down. You're going to be 45K out of pocket whenever that happens. Now is the sweet spot. You can get low out of pocket deals. And then at a later point, you can refinance into that lower rate and crush it on the cash flow. But don't wait too long. That's for sure.
Yeah. People who try to time the market are making a huge mistake. Is you don't have a crystal ball. You can't see the future. The best time to invest in real estate is always today.
No doubt
Get
about
going.
that. Steve and I were talking last night on a side note. We were both talking about when we made a significant portion of our investments, and it was in a down market, totally a buyer's market. We made a lot of investments back in the great financial crisis. We're talking about 2011, 2008, and the only thing that he and I both said is all those deals that I passed up over 5,000, 10,000, just trying to over negotiate. I should have bought every damn one of them. I mean that's the right answer. We should have just
Yeah.
bought all of them.
That was my mistake too. As you said, I look back, I shouldn't have bought 20 houses. I should have bought 70 or 80.
Yep. Yep. That's the answer. All right, let's look at Dallas in comparison to this. Jeff, where do you see and jump out at Dallas, or maybe a comparison between Dallas and Houston?
So Dallas is, let's see, uh, active listings 32,000 versus 7,000 sales. It's not like Houston. If I look at Houston, I always look at the sales versus listings, and you look at Houston, 28, 48, and 50, and the sales are pretty flat. Dallas hasn't really had the same type of like opportunities I think that Houston has. Because I look at Houston, I see all of those listings and the same number of sales they had roughly, 6 years ago, and it makes me think, wow, that's a lot of people that are probably a little more desperate to sell their house. Dallas is not that way. The prices are roughly flat. They're down 1% on both. Months of inventory 4.5. That is the lowest number in Texas. Days on market's a little higher than Houston. I know, Steve, you mentioned 55 days on market in Houston. That's actually the lowest by a good bit. Dallas is second at 63. So, like we always talk about in Dallas, the rental deals are probably outside of Dallas proper, on the outskirts. That's where you need to go to find your investment properties. You can find some in Dallas, but the majority of them are going to be a little overpriced. You need to move outside of Dallas, but Dallas is strong. It had a huge run up. It's kind of flattened out a little bit, but there's still tons of opportunities there.
Yeah, I completely agree. I think whenever you look at these markets and you say, we're going through a ton of different data points. The thing that still jumps out at me, Houston, we didn't talk about this yet, but Houston, you got up 1% on average sales price, down 2% on median. You got Dallas down 1% on both. Basically a flat market, right? We've been in a very difficult rate environment and values have not really come down. So whenever rates come down, without question, there's a ton of pent up demand. People who want to level up in a house, first time home buyers that want to get in, people move into the area. We have, and we're going to cover some slides a little bit later on. We have tons of people moving to the state of Texas, and they're all renting for the most part because they're not buying. Those people all would like to buy because they're probably coming here for a good new job or something like that. So there's so much pent up demand. When rates come down, you're going to see appreciation to get back at a minimum with the historical trend. I personally think a lot more than that. But if we are staying flat in the rate environment when very few transactions are happening, that's telling you something. And that is that it's still a very desirable market. And that I think whenever rates go down, home values are going to shoot up. I fully believe that.
Yeah, that's the thing. Like, you would think that with this seemingly imbalance between buyers and sellers, you would think you would see a much greater drops, and you just don't have them. And I think it goes to your point. It goes to the fact that so many people are moving into Texas for all the right reasons, right? Jobs, opportunities, low taxes. They see it as a great place to live. So, yeah, you would think you'd see much lower numbers, but you just don't, because it's propped up by people want to come here.
I do want to point out one really positive thing for Dallas too. If you look at that in 5-year period, the lease rates are up 42%. That is a really big success story. And the great thing about that number is think about this. That doesn't mean somebody's cash flow has gone up 42%, right? Because the entirety of the rent does not make up the cash flow. If before this went up 42%, you might have been cash flowing, $400, but whenever you go up 42% on the rents, your cash flow might have doubled. So the great thing about rent rates going up is that going up 5% does not mean your cash flow goes up 5%. It's a much bigger increase to your cash flow because your cash flow it's a smaller core number, right? So those numbers should be very exciting. Houston is not as much. The rent rates in Houston have not gone up as much as they have in Dallas. So that is a good success story for Dallas. San Antonio.
Even with that minimal increase, if you think about it, over a 6-year span, raw numbers, Houston's gone up $500.
Yeah.
You're looking at cash flow deals that go 200, 300. Well, it just went up 500 minus an increase in taxes and insurance, but still, that's still significant.
Very significant. All right. San Antonio, I was actually talking with some investors last night, just talking about the San Antonio market, and we see these reports come in. I don't think we have any this month, but there's some good articles on some other markets. But on San Antonio in the past, I've seen a lot of articles come out that say arguably one of the highest potential markets over time. Well, when we get to the last slide on the affordability index, we can deep dive some of the reasons for that. But here, you have arguably the most buyers market from the three we've covered thus far. 78 days on market. That's a big jump from September of 2019.
Wow.
Months of inventory. Steve talked about this earlier. That equilibrium is 6 months, right? We're at 5.9, so that's right up against it. What's interesting is the inventory, the active listings is not double like Houston is, but it's up a good bit. Home sales are down a bit, but and the values are down 1%. A couple of months ago, actually, San Antonio was the highest uptick in the summer. Not the case anymore. But I would say a lot of our investors are taking advantage of deals in San Antonio at the moment because there are some good deals out there because of the slowness of this market. Wholesalers are getting pretty quality buy and hold deals. Even more challenging probably to sell a flip out there. That is definitely true because of the days on market, but definitely some good buy and holds. Anything else jumping out here, Jeff or Steve?
The only thing because I agree. I think it's kind of like what you talked about earlier. It's a great opportunity for buy and hold folks because there's just a lot of pent up demand. A lot of sellers need to get out of their properties. If you're going to do a flip, there's still ways to make money in flips. You just have to buy it right, right? Like Wade said earlier, find the right sweet spot as far as the price goes, do a good job on the rehab, make sure you're buying it right, account for extra time on market. You can do it. The only thing I look at San Antonio that I don't quite get is I look at the average lease price. San Antonio, the rents are significantly lower than Houston and Dallas. But if you look at, well, I don't have the numbers from 6 years ago, but it just seems, $400 or $500 less per month in San Antonio. I wonder why that is, and if there's something on the horizon that's going to make that better. That's my only thing about San Antonio I can't quite figure out because everything else makes sense.
Yeah, I got to agree with you, Jeff. That is odd. So there may be a correction coming where those rent prices increase relatively quickly because the word's going to get out. A lot of people are going to move there, and that's going to drive the rental rate up. Because, like you said, most of those people are waiting to buy. They move, rent, and wait to buy. And I think that will jack up the rental rates because that is crazy. 0% increase over a year.
Yeah. I think there's a little bit of slowness on the market, but I do think whenever rates come down, we're going to see some big jumps for sure. All right, look at Austin. Austin is an interesting number. Total active listings, double. Total home sales actually down from pre-COVID, but the listings are double. We're going to show some reports a little bit later on that talk about Austin. Definitely some indications that good buyer's market there. That is more of a flip market unless you go farther out, but there are some green shoots too. If you look, the months of inventory is coming down from last year, and the days on market is coming down. Now, these are still, the days on market is a higher number. That months of inventory number coming down to 5, that shows a little bit of positivity I see. Anything else jumping out here for you too?
It's still those days on market. That's shocking.
Yeah.
That's 76 days. That's amazing.
Yeah, like you said, we don't do a ton of deals in Austin. Buy and holders, it's just tough to cash flow at those prices. The duplexes and fourplexes all day long. Those are great opportunities. That's what I see.
Yep. Okay. Jeff, this next slide, talking about another cut from the Fed.
Yeah.
You want to talk about that a little bit?
Sure. So the Fed cut 25 bips to 3.75 for the second cut this year, aiming to support a cooling job market while inflation hovers around 3%. So, this is kind of what we've been expecting for a while. As long as inflation stays low, if the job market is kind of ho hum, I have no doubt they'll probably drop rates again. As you know, the commentary was not a foregone conclusion for December. Powell said any further easing will be data dependent, which is what it should be, right? That's how you should manage these things. It should be based on what the feedback is telling you. So, you know, we talked about this a couple meetings ago, maybe, about how, you know, it doesn't magically, when the Fed cuts rates, it doesn't magically mean everyone's rates drops by a quarter point that next day. That's not how it works. But it is a, you know, as long as it's dropping and the margins are not increasing, they're staying or reducing between that and the 10-year. That means lower interest rates for everybody. So it's good news. Can hopefully feed a little bit, like Wade said, a mini refi boom that we're in right now could continue or get even bigger for people to pull cash out and buy more houses.
Yeah. You know, the bond market can tell you a lot about where people are predicting interest rates will go. And there's also a lot of analysts out there. And what I see is that people are predicting in the next year that the Federal Reserve will take rates down to about 2.8, 2.7, something like that. So down anywhere from 1 to 1.2% from where we are today. That does not necessarily have a direct correlation to the mortgage rates we get. We all know that, right? Because there's the Federal Reserve rate, and then there's also a mortgage spread. That mortgage spread was at a really high number for a while there. It's coming down, which is good. That means our bonds are more desirable on the open market. So that's a good thing. But there should be some reduction if we take that, for sure. I mean, that's very predictable. If we're down 1 to 1.2% where we are today, I think that's a good indication of where we're going to go. And that presents a sweet spot, everybody. If you wait until it's too low, then the out of pockets are going to be up. I can guarantee you're not going to be seeing 5Ks out of pocket, 10Ks out of pocket if rates come down this much. That ship will have sailed. We've seen that in the past already. So definitely think it's a good time to get in before that happens. And that's not to say that the people were getting bad deals when they were doing 45K out of pocket, because they were also getting 400 or 500 cash flow. Like that's also a good deal, but it's a unique opportunity to be able to buy now with very low out of pocket and refi and still get those type of cash flows. That's a unique opportunity.
Yeah, like, I mean, if you want to talk about refinances, that's obviously like individually situation specific. But as far as just buying real estate, you know, when rates go down, prices are going to go, cash out of pocket is going to go up, and vice versa. But you guys said yourself earlier today, right? Like, you wish you would have bought all. I don't know what the rates were. When you guys were talking about the houses you should have bought back in the day, I don't think rates was even mentioned. It had nothing to do with the conversation. It was purely buying the real estate. So if you're looking to refinance, yeah, look at the rate and what you have in your situation. But if you're looking to buy deals, it's not a bad time to buy deals, no matter what's going on. It's just a different market. Like, you may have cash flow more out of pocket, or less cash flow, less out of pocket. But to Steve's point earlier, timing it, nobody can time it, right? You don't have the crystal ball.
Yeah. I think the interest rates, my recollection, they were a little bit lower than where we are today. Probably not lower than where we're going to be next year. But to your point, rate is just a factor, just one factor in evaluating a real estate investment, right? It's not the factor. It is just one factor.
Yeah, if you buy a deep enough discount, you can flip houses now, you can do rentals, and there are a lot of deeply discounted properties out there. And it's still a decent interest rate right now. It's just a normal interest rate. And like you said, you're marrying the property, not the mortgage. You can always refinance it if the price, if it drops 1.5 points, yeah, refinance it.
Yeah. It's interesting. I was talking with an older person the other day who has made a ton of money in a lot of different things, mostly real estate. But he was talking about how he bought a lot of his properties during kind of like a lull especially in Houston in the 80s, because there was some oil and gas crisis, and scooped up some deals. And I said, what was the average interest rate you were getting on a deal back then? And he said, man, probably 14, 16%.
Yeah.
Like, most of the people in the current environment would have their heads blown. They'd say you would have to be a complete idiot to invest in real estate at 14 to 16% interest rate, literally double where we are today. And that guy says, I mean, I just printed money off of those deals. Like it's
Yeah.
just been amazing because the home prices have gone up so much since the 80s. It would just blow your mind if you looked at that trend.
But I wish you would have asked him what the average price was for a distressed house in 1981, because I bet it was pretty cheap.
Yeah.
Yeah, I bet it was 25 cents on the dollar because
Yep.
I remember I did a couple of flips at the end of really the big catastrophe in Houston, the oil and gas bust, and they were 50 cents on the dollar, and these were Galleria houses. I'm
Yeah.
talking you can see the Galleria right across the street from them.
Wow.
I mean, it was a nice area and still able to pick them up for really less than 50 cents on the dollar.
That's amazing. Let's look at this next slide. We've been talking a lot about it, buyer's market. We talk a lot about Texas, but this is an interesting article, Jeff and Steve, interested to get your opinion because we're seeing the strongest buyer's market in 10 years, according to this Redfin article. What do you guys see here?
That's definitely a buyer's market. I mean, if you are trying to time it, now's the time. You've got an opportunity to get out there and get good deals. That's for sure. Estimated 35% surplus of sellers versus buyers in August. June posted an even larger gap. I didn't even know that.
Mhm.
You just look at
You look, go ahead, Jeff. I'm sorry.
just say, yeah, if you look at the widest margin since 2013, that was, that was basically the end of the GFC, right? So, which was real estate driven. So that tells you, this is pretty extreme when it comes to the numbers. So, like Steve said, it's a great if you're going to time it, now's a good time. But that's just the fact that that gap is all the way back to the GFC. That's an opportunity.
Yeah. And look at I mean, just think about this for a moment. What was happening whenever that chart was inverse back in 2021, 2022? You guys remember that was not a buyer's market. If you had
Yeah.
a property listed, you're probably getting 10 offers way over ask price. As a buyer, you could not get a deal. You were just saying, I will pay whatever you ask plus 15%, sir. And I'll be happy if I'm lucky enough to get it. That was the environment back then. And
It was.
so if you want something different where you can get a quality deal, like you have some leverage in the negotiation, it's whenever you're at this 35.2% number, which is the highest since 2013. All right, next slide. Talking about Austin, I mean, it does seem like this might be a time to try and get some deals over there. Of the U.S. cities reported in this data, Texas major metros landed in the top 10, especially Austin at number 1, with a staggering 130% more sellers than buyers. And you look at the next closest, 118.5%. That's a pretty incredible number. And you've got all of the Texas markets here: San Antonio, Dallas. Houston's way down from the others, but still in the top 10 there. But that Austin number is pretty impressive.
Yeah, that's shocking, especially Austin. You could pick up some good deals around Austin now in that circumstance.
Yeah. Jeff, you want to go over this next one?
Sure. So Texas, kind of like we were talking about earlier, Texas inventory continues to grow, only second to Florida in September. Statewide active listings continue to rise heading into fall, improving buyer choice, kind of like what we've been talking about. Texas is ranked second at 181,000 active listings. Florida is first at over 200,000. More price reductions and longer days on market reported across several Texas metros, and anticipate more ability to negotiate better entry prices and credits on turnkey product. That last bullet point is what the takeaway should be if I'm a real estate investor. You have way more ability to negotiate price. You never know what that person's going through, what their situation is. I don't use the word desperate, but like how motivated they are to sell the property. So it does smell to me it's a good opportunity, like I said, to like we've been saying, to keep making offers. Buy it right. If you're going to flip a property, buy it right, which means you may not get most of you're not going to get most of your offers, but it only takes one, right? So it's just kind of, this is kind of backing up what we've been talking about.
So Steve, just wondering your opinion. California is the most populous state, has the highest population, right? And it has 114,000 active listings versus Texas and Florida, which are exponentially higher. Why would
Yeah.
you guess that would be? Just curious.
I know people want to live in California. I don't know why. It's almost a communist state. Um, and the taxes are insane out there. But if there's only 114,000 listings, that's got to be a seller's market.
Yeah.
But the truth is, you can't make money very easily in California because the price of homes is astronomical compared to Houston, Dallas, Austin, and San Antonio. I've had people come in and sell a $7 million home, right, in California,
Mm-hmm.
and come here and for $1 million buy a bigger house with a pool, with a whirlpool. Um,
Yeah.
and that leaves them $6 million to invest with.
Yeah. Yeah. It's crazy, right? And they
It's
have a
crazy.
bigger, better house
And
with
a
a
bigger
larger
and
lot.
better house.
Yeah. Yeah. You know, I kind of did some research on this, and we haven't put this out in a while, but for the better part of a couple of years, and it's still the case. Uh, Both Houston and Dallas have more open permits than the entire state of California. So
Oh,
there's not that much new construction. That's a big part of listings. The average bear, unless there's something, I would say borderline. I don't want to say cataclysmic, but like significant in their life, people aren't giving up the 3% rate to go and get another deal at 7. Like that's just not happening or 6 right now. Sorry. It's just not happening a ton. But people are buying some of the new construction, and that's where a lot of the listings are in Texas and Florida because we can still build them here because the regulations aren't outrageous. We were talking with a person that we work with heavily on our long-term side yesterday that lives in California. They've been trying for the better part of 2 years to get through a permitting process on an Airbnb that they did. And then whenever they had all their ducks in a row, they were just told, sorry, we're changing the rules and you can't do an Airbnb anymore after 2 years of trying to get a home built. So yeah, they can't even rent it anymore. Don't know what to do. Just change the game. They said the bureaucracy and red tape is just crazy. So anyway, I think that has a lot to do with the different listing
I
numbers
agree.
as well.
I was doing a little research myself. I was like, why is this? But you're right. The first reason was there's so much new construction in Texas relative to the rest of the country. So if you think about it, there's great jobs, low taxes, low cost of living, and it's probably going to stay that way, right? Because Texas is huge. You just look at the metros, right? Look, they just keep expanding. You can find new construction everywhere if you drive out in the suburbs, like in Houston, for example. So I do think that's it. It's got to be the new construction. That's the only reason
Yeah.
why it's such
Yeah.
an imbalance.
Yeah. I mean, California is huge too. I mean, they have a lot of land, but it's just you're not allowed to build on it. So it doesn't matter how much land you
Great.
have.
It looks pretty, but yeah.
The next slide is interesting. David did a really good job of putting together some interesting slides. Really appreciate it. Did I go? Yeah, here
No,
we go.
that's it. That's it.
Okay. Yeah. So over the last 12 months, Texas has added 195,000 jobs and hit a record labor force number. Texas growth rate outpaces the national rate, which is a really good sign. And then setting new records for position creation in 2025. So a lot of job market related things, which really brings in the population without question. And then this next slide, just transitioning into that, this is one I was excited about. So if you're looking, I want to invest in real estate. Like you got to not only be looking at the moment, but thinking ahead. And this net migration number should motivate you, right? This is a very strong number. Eventually, these people will buy homes. Right now, they're renting, right? We all admit that. Like people are wanting to get to know the area and or waiting on rates to be a little bit lower. but adding 562,000 folks is the biggest net gain, right? And you contrast that with a state where they're not building new properties and have some other challenges. That's a $238,000 reduction. I'm sorry, 238,000, not dollar, people reduction. And then a lot of the millennials, like they're going to be first-time home buyers, right? They're getting the new job, making sure it works. They're going to want to buy that first home. They're probably good jobs to take the risk of moving all the way from other states or something like that. So I think that along with the buoyed lower rates, I think that's why we're predicting, a lot of other people are predicting big jumps in home values over time. Anything else jumping out here?
I just think that, the thing that I noticed was, like you said, the millennials. You know, those are folks that are they're probably renting now, like you said, and they will be buying. So, and then taking the long view is a great point, because the fundamentals for a solid market are here, right? Job creation, low taxes, like good weather. You know, it's a little hot sometimes, but it's just, it makes sense why folks are moving here and moving out of other places that taxes are high. It's, you can't, there's no, like, if I were living in, if I was in, you know, a 25-year-old in California or LA, like, what kind of hopes do you have to buy a house? You know, like, it's just, it's soul crushing, I would imagine.
Yeah.
Yeah, it's terrible in California for a young couple. You know, they have their first child and then they're expected to pay a couple $1,000,000 for a home. It's just not happening.
Yeah. This next slide here, this is interesting. Investors accounting for such a large portion of the market. You know, I was talking to somebody the other day, and the difference between investors and homeowners is investors aren't just saying, here's the money I'm paying for something. They're saying, what is the quality of the investment? And that does not just get dictated by an interest rate, right? That's the big game changer. And to see 33%, you know, people always have a fear of missing out, or sometimes people want to follow the crowd. Um, a lot of investors are buying properties right now, and most of it is that big time institutional money. People that have, you know, big groups of financial analysts. They're predicting the future. They're looking at all these different metrics to determine if things are smart or not smart. And you know, these big institutional investors are buying up property, especially in Texas and other Sunbelt states, in huge numbers. But that 33% number, that's pretty incredible.
Yeah, I do want to say something about the institutional. Look at the second point. The institutional buyers only bought 13%. Small investors like you and I bought 87% of the investor homes. So those institutional people are scared of them. They're worried they're going to destroy the market. Don't worry about them. They're, you know, you can see from here, they're 13% compared to 87% are the small investors.
You know, Steve, I don't have it right in front of me. Maybe David, you could grab it if you have a moment, but I also think that number's right in line with the ownership percentage of properties that are owned by mom and pop investors versus institutional historically. I think that number's pretty close. I think
Oh,
it's in
wow.
the 80% off. And I read an article a few years back that said the reason why. It's just hard for these institutional investors to scale it. It's just not an easy business to scale. You know what I mean? Like, you're buying a property in Houston and then in Nebraska and then Nashville and everything like that. It's just not an easy thing to
I
scale.
find You're gonna find GCs. You know, it's not like you can
Yes.
go grab. There's no McDonald's of GCs, right? They're all local, and it's just a lot of blocking and tackling, boots on the ground type of stuff. You're 100% right.
Yeah. Yeah. All right. We got about 15 minutes left. We have a couple more slides to go. But this is interesting. The asking rents rise the most since 2022. Um, the number of new apartments hitting the market also has dropped 45% since the pandemic. So what that means is supply and demand market, less inventory of rental opportunities coming on market. So I know we've seen relatively flat rental numbers, but that seems to be a little bit of wind in our sails as landlords, right?
Yeah, I'm seeing a lot of properties literally with waiting lists. At least, I'm being told they've got waiting lists. I went to an apartment owned by one of the big firms. It was full, and this was a 500 unit apartment complex. It's hard to keep a 500 unit apartment complex full. So, yeah, what you said makes sense.
Yep. All right. Um, Anything else, Jeff, before we go to the next one?
No, Steve is the apartment man. I defer all
Let's
the
see.
questions, Steve.
All right. David said that he found some information that's saying that number may be closer in the 70% range of people who hold the properties, but still mostly mom and pops. So some good data there. The
You're saying
rental vac
70%, 70% traditionally are the mom and pops and 30% are the institutional?
I don't, that's one number that's found. I think if it, I don't have a perfect memory by any means, but my recollection was there's some data saying that that's higher than that, but that's the data that David just found, and that's what I'm going to communicate. Um, Jeff, do you want to cover this one?
Sure. So just we're talking about rental vacancies. You know, when it's pretty simple. When it's easy to buy a house, you have a little tougher time filling up your rentals, right? When it's more difficult, it's much easier. So you look at the peak of this chart, and starting around 2005, 6, 7, 8, 9, 10, vacancy was a problem because there was a million stated income, stated asset loans. Yeah, I make $20,000 a month as a, whatever. It doesn't matter. So it was easy to get properties, easy to get jobs. The financing was super creative, so you um, didn't have to have much money down payment at all. So it was easy to buy a house. Now, ever since that happened, underwriting guidelines have significantly tightened up, and you see the rental vacancy rate drop. Right, people need to find places to live when they can't buy homes. It's great for landlords. So, um, we're it's a little bit on the upswing since 2022. I'd be curious what you guys think why that is. Um, I guess it's just a little more affordable. I guess since the rates dropped, or I'm sorry, since the rates went up, they've normalized and people are more likely to buy houses now.
Steve?
That's a tough one.
Mhm.
Um, I'd have to say that even though the drop in the interest rate doesn't necessarily affect the mortgage rate, psychologically, the government is saying it's a lower rate. People don't understand that. So they are going to go out. I think more people are going to go out. If they keep dropping the rate, there's going to be a lot more people go out and buy because that's what they're waiting for.
Mhm.
I think you're right.
I agree.
But
On
one
a
thing I
side note,
want to say about this 7% vacancy, remember everybody, they're going off of MLS, multiple
right?
listing service. Mom and pops probably have a lower vacancy rate than the people who lease their properties on MLS.
Yeah, there's a lot of alternative strategies that are pretty darn effective.
Yeah.
Sizes of the yard, social media, a lot of different ways in which to do that. So, and there's a million different ways to slice this data. I typed in what percentage of single family investments are owned by mom and pop investors, and here's some data. And there's different prognosticators. One report says that owners of 1 to 5 properties account for 87% of all investor-owned homes. Mom and pop, another one says mom and pop landlords with 1 to 9 properties own 80%. Owners of 1 to 5 own 87%. That's a little bit closer to the data I had seen historically, and pretty much in line with what we saw just a few minutes ago on who's buying what too. So interesting. All right. So the interest rates, I want to bring a little bit of context to this, right? So as a friendly reminder, you go back from this chart probably started in 1960-ish, I guess, until, you know, early to mid 2000s, and the rates where we're at today is like historically low in that in the entirety of that time frame. Now, whenever you get into,
That's
after the
15.
great financial crisis until 2022, the rates were absurdly low. But that is an anomaly historically. And I don't know that we're ever going to get back to that. Like there were some real negative effects to the fact that rates were so low. There were some real negative effects of that. You couldn't put money in a money market account and earn anything. Like there's some negative effects of that. People are prone to make more aggressive investments in the stock market, things like that, because they can't earn a decent rate in a savings account. So I think that we might have learned some lessons there. Most people out here say probably never going to get back down to basically 0% interest rates like we did for a hot minute there. But and throughout this time, people made money in real estate. That's the simple reality of it. People made a lot of money in the 80s, a lot of money in the 70s, a lot of money in whatever. The reality is it's just a factor on your investment process. And it's a mistake for us who are maybe newer to the space to get overly fixated on interest rates as the driver to get in the game, right? That's kind of the moral of the story from this chart, in my opinion. You guys have anything else to add to that?
Yeah, it's ridiculous to wait. It's ridiculous. Now is the time to be buying. Just make sure you've got a, situation where you've got distressed property, whether it's divorce, loss of job, moving, or deferred maintenance, which is the big one. Most of them are deferred maintenance. They need to get out there and start buying.
For sure.
Yeah. It's always fun to see this context. Because you're right. I don't think it's ever going to get down to I mean, basically, how can it? It was almost zero, right? It's not going to get that much lower.
Yeah. Well, I think with some of the things that have happened, we thought we could really have hit the 2% inflation goal with like non-existent rates, and that's just not. It just doesn't seem like that's going to happen. So I think those days are past us. This affordability index is something I always love to look at. We talked about San Antonio a little bit earlier. You look at San Antonio versus Houston. It's something that always amazes me. Still the same. The average income in Houston and San Antonio are a couple bucks apart, but look at the average home price difference in San Antonio versus Houston. That's a telling number there, right? So you got Houston there at 369, San Antonio at 279, a $90,000 difference, where the average person makes the same money. So San Antonio, I do think, is a very good market that has upside on home prices. Now, Houston is still, considering the amenities, Houston, top 5 largest city, tons of amenities, exponentially more affordable than anyone else. And the trend for affordability in Houston is damn good too. You look at this, and this is basically called the least affordability index. Houston was the 24th least affordable city in September of 2019. Houston was the 32nd least affordable city in 2024, and it's the same today. But moving from pre-COVID, that is a big improvement in affordability for Houston overall. That is a big game change, right?
Yeah.
Anything else jumping out here?
Nothing for me.
Steve, do you guys? I meant to ask you. We didn't talk about it because you have Austin. Obviously you're in Houston, but you also have a Dallas office.
Yeah.
How's it going up there in Dallas? What are they seeing up there?
As far as single family,
Yeah.
it's slow, but I think that's because people are afraid and they're, again, waiting on the interest rates to drop, So it's very hard to get that out of people's heads. But they are doing deals and they're way below that home price average. Because we're really in the outskirts of Dallas. I want to make that clear. We're really not buying in Dallas. We're buying in all the little suburbs around Dallas. And that's just making money hand over fist.
Yeah.
Do we have any questions for today, David?
Yeah, so a couple questions I thought might be relevant. to our conversation today, just in the last 5 minutes that we've got. Um, One question you have is how do you guys quickly decide if a deal is worth pursuing whenever you are looking at investment properties?
That's a great
I'll tell
question for
you,
Steve. Yeah.
it really comes down to the comparable sales and the comparable rents. The minute you find a deal, you want to get comps on that. You want to get them first from your agent or wholesaler, but your mortgage company will check those comps because they're going to run their comps as well. So I look at those comps, I look at the rental rate. I've got a little spreadsheet that I put it in. It shows me my cash on cash rate of return or how much money I would make if I flipped it. And I can decide in about 5 minutes whether I want the deal or not, again, based off of primarily the comparable sales. Because if the comparable sales are 350 and I'm picking it up for 220, I don't need to think very hard about that. I'm going to get that thing under contract as quickly as possible.
Yeah. To Steve's point, you have to have a couple things that you can quickly do. One, you definitely need to be able to come up with an after repairs value. If you're doing buy and holds, you also want to be able to establish an average rent. And then you want to be able to look at that repair budget and do your math. And then a great thing is if you work with somebody like sort of like our team over at Catalyst, you can reach out to us and we can give you a loan estimate on what your hard money out of pocket's going to be really quick. Our loan officers are always available, and you can find out what your out of pocket is, because a huge part of that investment evaluation is the ROI, either on a shorter or long term deal. If you can be out of pocket 15K and you can make break even on a flip, maybe even double your money, which we do see sometimes in this market, like make 30K on a 15K out of pocket, that's a huge win. And so understanding your out of pocket is crucial, and you can do that if you have a trusted loan officer you can work with. Jeff, anything to add before we wrap up?
Yep. I was just going to ask Steve. So the individual deals, that's good advice. If somebody is wanting to say, okay, what areas? Because like Houston's huge, right? So like,
Yeah.
are there any like tips for looking at or avoiding certain pockets? And maybe not the specifics, but just like characteristics that would make you attracted to or repelled by an area?
Yeah, I look for neighborhoods where the ARV, after repaired value, is between 250 and 350. Those are the neighborhoods I go into, and they can be anywhere, but if it's at that price point, you've got good middle class people that take care of their property. That's the sweet spot for renting, and in my opinion, for flipping too, because that's where the majority of people are living.
Yeah. Very good advice. All right. Well, just a friendly reminder before we wrap up, we are going to be doing something a little bit different this upcoming month in concert with Total Wealth Academy. In the month of both November and December, we're going to do what we call lunch and learn / deal day instead of a deal night. We're going to have about 45 minutes of education on how the hard money process works and finding off market deals. Then we're going to present some off market deals. For the people in the Houston area, they'll be able to attend that directly. But in addition to that, we're going to have the ability to access them remotely. And I think about half the properties purchased last night at our deal night event were purchased by people from out of the area, right? So if you want to learn more about that, reach out to Total Wealth Academy or Catalyst Funding. We'll get you set up with the information on that event. And I think it's going to be a lot of fun, highly educational, and you'll be able to buy deals right on the spot that can change your family's financial future, build net worth, build wealth. It's exciting stuff. Steve, as
David?
always, thank you very much.
Thank you.
Real quick. David, we have a winner?
Oh,
Yeah.
my bad.
No problem. I was going to interject before we left. So Luis Aparicio, I believe, is a Total Wealth member on the list, and he was the name that was pulled.
All right, Luis.
So Luis gets half off his next processing fee, like $750 value. As a
Awesome.
reminder to everybody, I know tons of people watch this after the fact on YouTube or something, but if you attend live, you do have the advantage of putting $750 in your pocket on the next deal, which is a nice perk. So we love for people to attend live because they can ask questions and be engaged. That's always a lot of fun. Anyway, thanks again, Steve. Thanks,
Thanks,
Jeff.
Steve.
Thanks, David,
Thank
for
you.
putting the data together. You guys have a great day.